Over the last week, we've seen a strong market, especially given the Fed did cut 50 basis points just a few days ago. However, one company that hasn't performed well this week is FedEx. Now, they did report just after the market closed, and we can see right now they are down around 15%. In fact, they are trading now towards their 52-week lows in the mid to lower end, and we want to understand, is this now an undervalued company for us to consider adding? Now, we have to bear in mind with their report of their earnings, they have disappointed massively. We're going to look at the numbers, and as we can see, they have essentially said that the demand for their products and services has started to drop significantly. And it isn't just that quarterly profit. In fact, they've lowered their full year revenue forecast. And the reason, as we can see here, customers are looking, in fact, for different options. They're looking for slower options for their parcels, and therefore they are moving away from FedEx, which we can see has been the more expensive choice for consumers. Now, going back to the historical performance over the last year, now given the drop, it is up only around 2.5%. Over the last 10 years, up around 60%. Now, if you do include dividends reinvested, you will have noted you will have underperformed the S&P, but again, depends at which point you were a shareholder. And as we can see here, a double buy rating from Seeking Alpha and Wall Street. In fact, Wall Street do like this, 4.22 out of 5, and that regular common hold from Quant. Now, in terms of the yield, it hasn't been updated. We will, in fact, shortly go through the metrics, and we can see a live rate for FedEx right now is sitting just over 2%. In terms of the forward P as well, around the 14 level, which is significantly lower than the S&P 500, sitting around 23. And when we take a look at their earnings, we can in fact see that revenue of 21.6 billion is flat year on year. Now, not great. Remember, on this channel, we want to see a minimum of 3 to 4% just to keep up in line with inflation. We also note their operating margin has decreased by around 170 basis points. Again, not something we'd like to see on this channel. Ideally, we want increasing revenues as well as increasing margins. We also note, and by quite some significant movement as well, the earnings per share is down 21% year on year. Now, to make things even worse, we do also note they have lowered their guidance, or as they say, narrowed. In fact, earnings per share was previously $20 to $22. We can in fact now see 20 to 21. And whilst they were aiming for low to mid single digit growth to their top line, they now have brought this down to low single digit, and ideally, like I said, 3 to 4% just to keep up in line with inflation. Otherwise, this company, in terms of real numbers, is reducing. Now, what about the metrics? What do they tell us? Well, firstly, dividend safety score 64. It does look to be safe. Yield 2.12%. We'll run through this model, which does show some reasonable valuation. And one thing we do quite like about this company is that dividend growth, an increase of 9.5% just over the last few months in 2024. Now, what does a dividend safety score ultimately mean? Well, first thing first, they reaffirmed this score in July of this year, and the safe score means that a dividend cut for FedEx is unlikely. Now, in terms of the last recession, 07-09, what was called the Great Recession, they maintained the dividend, didn't increase it, also didn't cut it. They had negative 16% sales, which the average was around negative 12, not too far off, but we do ultimately note FedEx negative 68% return during the period. The S&P did look a lot better at negative 55. As we mentioned, this is a company that does historically increase their dividend at a very attractive rate, double digit over both the last 5 as well as the last 20 years, and we can see only 4 years of those consecutive increases. There was a period during COVID where they maintained it, but ultimately over the last 22 years, they have been paying a dividend without a reduction. Now, when we look at it based on the average of the P ratio, we do get reasonable valuation. This is essentially shown by tracking the current price against the expected fair value. And when we look over the last year, we can currently see it is trading right at the bottom. Now, we will get to our own valuation model towards the end of the episode. We also on this channel like to look at dividend yield theory, where in fact we do get here an undervaluation signal. The yield sits at 2.13 above the 1.84 average, as well as the forward P now at 12 below the 5-year rolling of 13, and we note it is significantly lower than the sector P of industrials at 20.3, so that is a triple undervaluation signal. We also take a look at the payout ratio for that dividend safety. We want to see below 60%. Over the last few years, in the more recent years in fact, we see some very nice numbers well below 60%. 35 over the next 12 months anticipated, and we do believe they should be able to continue to offer those increases at the double-digit rate that we have come to love. And just a quick side note, we do tend to ignore earnings on this channel as it is susceptible to manipulation by management through accounting. Then we get to the free cash flow. We want consistent increases over longer term. Not something we actually see with FedEx, although it has increased nearly 4 times over the last 10 years. A lot of inconsistency. The positive thing we have to point out here is over the next 12 months, it is anticipated to increase by around 20%. Always a good sign to note. And while we do want to see 3 to 7% to their top line, we have pointed out for the full year of 2025, they're expecting low single digit to their top line. And over the last 2 years, we do note negative growth. Also, bear in mind, they did lose the USPS contract as well to UPS. So that is something that will be stripped from their revenue moving forward. And just as a side note as well, UPS, based on this information, is down around 3.5%. Now continuing, we can see, numerically speaking, over the longer term, they have pretty much nearly doubled their top line revenue. And also very inconsistently, they have returned a little bit of excess cash over the years through those share buybacks, but also understand they have diluted your position over some years as well. ROIC, we want to see 10% or more. Now, what we get here is very, very inconsistent. We can say over the last few years, it does look to be okay around that 10% point, but there are some years, COVID as well as pre-COVID, where it did dip to single digit. And what we also say on this channel is, whilst we do like to pay a little bit of a premium for companies that do have that consistency, something that FedEx we can see doesn't have, on the flip side, companies that don't give us that consistency, we will like to use a little bit of a higher margin of safety that we will come to in a minute. Operating margin above 12%, it hasn't hit that over the longer term. Whilst it has been increasing from the 2% lows of 2019, 8% still leaves a lot to be desired for the margin side. And in terms of the free cash flow margin, again, over the long term, we don't note that consistency, 4% in 2024. Now, it isn't too far off that 5% minimum we want to see, but again, do bear this in mind when you are coming to your own investment thesis about whether or not to add FedEx to your portfolio. We then get to the net debt to EBITDA, referring to the earnings before interest, tax, depreciation, amortization. Below 3 is what we want. These numbers below highlighted and the number of years it would take the company to pay off all of their debt net of cash on hand. Reason we like this metric correlates to dividend safety, balance sheet strength. 2.9 in 2015 has been coming down, 1.98 in 24, 1.86 expected over the next 12 months. So it does look to be okay. We did see that safety score above, and hopefully we do believe they can continue to offer some nice increases moving forwards. Now, we also want to let you know we have released our latest free weekly article, sent every single Monday. We go through some high quality stocks as well as what's happened in the market over the last few days. So do click below where you can sign up and read straight away. You will also be able to grab the 25 undervalued stocks we have for the month of September for your consideration, where we run through each one as well as showing those that sit within our own portfolio. And you can also grab an additional spreadsheet where we run through 22 dividend stocks with the most upside according to Wall Street analysts. So do go ahead, click below and sign up and read straight away. On this channel, we also like to incorporate insider as well as institutional movement. Insider ownership, 8.8% with 51 million worth of sales over the last year. Now, bear in mind, whilst we don't see selling as a bearish signal, it is something we do like to show just for transparency while we try to find any insider buys. Remember, insiders do sell for many reasons, personal or financial. So 4.42 in fact in the more recent quarter. For those that do want to see who these insiders are, we can in fact see on the 18th of July we have that latest sale by the EVP, around 2,000 shares at the $310 mark for around $608,000. We then like to do the same analysis for the institutions where we have 85%, 3.4 billion worth of sales over the last year, with around double that in terms of the buys over the same time period. Although we do note in the more recent quarter, marginally more buying than selling, the same to be said in the previous quarter. So institutions do clearly like FedEx as a company within their own portfolio. Remember, always do your own due diligence, never copy their trades. And what we want to point out here is we've already seen the top line revenue, but again, as we mentioned earlier, it has pretty much doubled over the longer term with some nice increases, although we do see from the highs of May 2022, it has started to come down. We really want to show here the bottom line net income. Does it follow a similar trend? And straight away, 1 billion of net income in 2015, 4 billion in 2024, in fact more than quadrupled. And whilst we don't get that consistency as we can see on a graphical format, nonetheless over the longer term it is moving in the right direction. Just something though to keep an eye on as this company does move forward, especially with the poor guidance it has now issued. In terms of a health check then, total cash versus total debt, what we do note, around 3.8 billion of cash in 2015, just under 7 billion in their latest quarterly report, so just under double that position they had, and ultimately whilst it has increased, cash position also looks fairly inconsistent. As always, this number won't tell us anything in isolation, so when we do compare it to their total debt both numerically and directionally, what we can in fact see here is that it has increased substantially. In fact, we're talking a 5 times increase from 7.3 billion to 38 billion. And when we do look at it from a graphical basis, we can see whilst it has been increasing over longer term, pretty much over the last 5 years, it has stayed fairly flat. So again, something interesting to note, but as we did see through the net debt to EBITDA levels, they are declining. So ultimately, the balance sheet does look safe for now. In terms of the earnings, we just want to highlight the numbers. In terms of the earnings per share, well, they missed management targets by $1.17. We can also see a miss on the revenue of 336 million, so not great at all, whilst also considering they issued light guidance. In terms of the actual previous numbers as well as moving forwards, well, they still anticipate over the next 3 quarters to have double-digit growth to the earnings per share. However, whether or not you believe their targets, do note, especially in the more recent target where they missed, they have a 50% track record based on the earnings over the last year. Also, we can see if they do hit that May 2026 projection, the forward P will come down to around 12.5. Now on this channel, we also like to look at some gradings. The first one is the valuation. They get a C+. Now bear in mind, as we saw, that PE is around 12 right now based on the drop, and that is still significantly below the 20 of the sector as we saw earlier. So what this ultimately means for FedEx, you are paying a discount. Whether or not that much of a discount is enough for you to execute is a question we are trying to analyze and we'll get to in the valuation. And that is showing pretty much whatever valuation metric you use, FedEx is trading far below what we typically see in this sector. We then get to growth where they get a C rating. Now revenue year-on-year growth, very poor, -3%, when the sector as a whole has that mid-digit of around 4.1%. Forward looking as well, very low compared to the sector of 6%. However, in terms of the next 3 to 5 years, earnings per share is still anticipated to increase by 13%. When we compare that in terms of the metrics from the sector of 12%, FedEx does sit marginally higher. Then we get to the final metric, which is profitability, where they have an A+. Now we do notice gross margin 27% is a little bit lower than the sector of 32%, and that can also be reiterated for the bottom line, 5% versus 6%. Ultimately, what does give them that A+ rating is they have a significant amount of cash from operations, 8.3 billion versus the 331 we see in the sector median. Now, a quick conclusion for this part of the analysis, a double buy with the hold from Quant, C+ on valuation, C on growth with an A+ on profitability. Now, last thing before we get into the actual valuation, what we can see when we do compare this company against others in the air freight and logistics industry, it hasn't had the greatest last 12 months. Bear in mind, it was the number 1 against the competitors before they released their earnings, now up only 5% over the last 12 months. When we expand this over the last 5 years, we do still note they are around the top at around 88%, significantly better than if you want to compare it to UPS around 25%. And over the last 10 years, we can see they have lagged severely. Again, some of that is due to the drop today. Nonetheless, 83% over the last 10 years is very poor, especially when you consider the S&P has performed a lot better. Although you can see here, marginally higher than UPS. As always, bear in mind, past performance been very poor doesn't necessarily mean in the future it will be poor. It could be a lot better. In fact, it also could be a lot worse. Now let's get to the valuation. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $338, we're going to explain how we got there. The first model, Graham's valuation, the ticker symbol, the earnings per share, long-term growth rate, AAA corporate bond yield, to give us an intrinsic value with a massive undervaluation. As always, bear in mind we don't look at any one of these models in isolation. We then get to the multiples valuation, companies in a similar sector and size, their average P multiplied by the EPS of FedEx, another massive undervaluation signal. We then get to the dividend discount model, as we said, a company with a historically very strong growth. Now we've gone incredibly conservative moving forwards at 6%, and we do get a nice undervaluation, making it 3 for 3. We then move on to the DCF model with the free cash flow year on year. Average growth at 39%, in fact just last year at 18%. We've gone for around 10% in line with analyst targets. With a discount rate at 8%, we've got the present value of future free cash flows, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, our fourth undervaluation signal, and ultimately the intrinsic value is just the average of these four models that you see on screen. Bear in mind, you can grab a copy of this model by clicking on the pinned comment below to run through your own numbers, whether it's for FedEx or any other company. Now, on this channel, we always do a 10% margin of safety, which we kick things off with and execute if it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Look, if you believe that for FedEx, not something I'm convinced you are, it does look to be a buy at $304. Then we keep going till it's near the current trading price, and as we can see in today's episode, it isn't far off a 25% MOS, but right now does sit between the 20 to 25 level. Bear in mind they did miss significantly on both EPS as well as revenue. They've lowered guidance, so maybe 20% MOS isn't right there enough for you to buy. That is something that I would deem to be reasonable. For those that want to see it 30% around 236, and for those at 35 around 220, does seem like a more reasonable target if you do want to add this to the portfolio over the longer term. As we see though in today's episode, just a 20%. Now Wall Street's price target of 312, they have lowered it after the issues that we have discussed from their earnings report. Nonetheless, based on the current price, we see 21% upside, and for some people that might be enough. They might see this as a market overreaction, although it does feel like maybe this is one that we should give it a few more days before we consider whether adding to the portfolio. As always, do give us your thoughts in the comments below. If you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell. Don't forget to sign up to the free weekly newsletter. And as always, come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.